Right then, afternoon everyone, and just another update from us on the goings on across financial markets this week. We'll start with the calendar. A relatively quiet economic calendar. There's a few trade balance figures throughout the week. We started off the week with a non-manufacturing PMI out of the US, which showed quite a positive number, but the week started with a bit of downside in certainly in the S&P and in oil off the back of growing recession fears in the US, which is obviously not positive for these types of markets. You can see this S&P, which did have a bounce back off this kind of longer term trend line. Once we look back off it, did have a bit of a bounce back off it, but we are rejecting this 3900 level as we speak, showing a bit of a retreat from that downside move earlier on in the week, but we will get back to that in a second. We cross back to the calendar. We'll have a quick look across the calendar again. The main focus of attention this week will be the PPI figure out this afternoon, producer price index, inflation, the cost of producing goods, obviously consumers, the cost of purchasing goods. And we are expecting a pretty in line figure of 0.2%. Previous month's figure 0.2. Consensus for this month is a further 0.2 increase in the producer price index. And then we'll have to see how that comes out later on. I think any sort of weak inflation print is probably likely to be negative for stocks and positive for risk assets. Coming back then to the charts, this oil chart has continued lower. We were speaking last week about oil, selling rallies on oil, obviously proved quite fruitful over the course of this week. We did have a little bit of a rally at the back end of last week, and we have pushed lower again this week down to 72 where we are at now. It does still look like it wants to continue lower. You'd probably expect a bit of a bounce back now after 5 straight down days in a row, so maybe a little bit tricky to sell at the lows. Selling on rallies is a bit of a better option for trading. But then onto the dollar. The dollar continues to be sold on any rallies. You can see it's been trending lower back since September, but you've just had very clear lower highs and lower lows, as you can see all the way down here, and it just continues to be sold on any rallies off the back of the Fed slowing down the pace of interest rate hikes and approaching the end of their hiking cycle. When that cycle ends, we are still a little bit unsure. We have not got an exact figure. But we do have the Fed next week, who maybe can shed some light on when this may end. But we've got inflation cooling down. We've got the Fed approaching the end of the hiking cycle. But interest rates, are going to be above 5%. What that means for business conditions going forward is probably slightly negative. I mean, that's that's the fears at the moment that interest rates are going to be where they are going to be difficult for business conditions. And if unemployment starts to rise or continues to rise with that, that could prove for some difficult times ahead, certainly for risk assets. But this S&P 500 turned around a little bit yesterday, pointed a little bit higher today. We'll have to see how those PPI figures come out, but if they come out weak, that should send this S&P 500 higher. On this trend line, there should be a decent bit of liquidity the far side of this trend line. A few stops around the far side of this trend line, people backing out, and hopefully a few people then buying up through it. So I think any break of that trend line would probably send us up towards 4,300 as the next target on the way up. So that's a couple of 100 points higher as we get above this kind of most recent high of 4,100. So there's a decent bit of room to the upside, the far side of this trend line, and may present some good trading opportunities into the Christmas weeks. Euro dollar continues higher. We're back above 105, broke above these recent highs back end of last week, and then we have made a little bit more of an attempt higher. In terms of the week, we are a little bit unchanged on the week. Not a massive amount of change on the week. But if we break down the chart and just have a little bit of a look down on the lower time frames, anytime this seems to spike lower at the moment, you get a push lower here, spike back higher, push lower, spike back higher. You get a bit of a dip here, push back higher, dip here, push back higher, and again we made another dip this week, and then we've pushed back higher again. So where we have ended is not that much higher than where we started, but all these dips continue to be bought. Right, we do not have to create fresh highs every week and push higher every single week. There's enough tradable opportunities within these dips to take 50 or 100 pips back to the upside. So I think buying euro dollar on dips, selling the dollars on rallies. Selling the dollar on rallies seems to be the way to continue to play it at the moment, but obviously that could be changed by some figures that we've got coming up. I spoke about the PPI again. We'll be looking for that personally for some trading opportunities. I'll be hoping for a figure of under 0.2. If you could get a negative print on that, I mean, that should provide some good trading opportunities into today. But as we have a flick across into next week, we've got CPI out of the US, the core CPI and the standard CPI print on Tuesday of next week. We've also got the Fed on Wednesday of next week, where we do get updated economic projections. So we will see another dot plot as we come into next week. The last one we had back in September showed a 4.6% terminal rate for the federal funds rate. What that ends up being into the future, we'll get a better indication of that with these economic projections on Wednesday of next week. So all eyes will be on that as we head, well, not all eyes, because you got half your eyes on CPI, half your eyes on the Fed into next week. But that will hopefully provide us with some good trading opportunities, and hopefully we can take advantage of that. We got some figures out of the UK as well. You got some GDP figures on Monday. Predicting a slight uptick in the GDP figures for October. So, you know, in terms of the cable chart at the minute, have a quick look at cable. You know, that continues to be the same as euro dollar, continues to push higher. Any of these dips continue to be bought, and this continues to rally. You know, if you get some positive figures out of the UK, some positive growth figures, that might prove supportive for sterling going into next week. You know, it could be a good way to play it against the dollar if you get some weak inflation figures out of the dollar. If we get positive inflation figures, higher than expected inflation figures, what that means is, I'm a little bit unsure. You know, personally, I don't think that really changes the path. We're slightly higher. I mean, okay, yeah, the terminal rate may end up a little bit higher, but it doesn't change the fact that regardless of what these prints are, I still think we are approaching the end of the hiking cycle. You know, we're going to get an indication of where that might finish and when that might finish, what the terminal rate may be. But whatever way you try and spin it, the bigger picture, the kind of macro outlook is still that we are approaching the end of this hiking cycle. That is negative for the dollar, has been negative for the dollar over the last couple of months, and is positive for stocks. What it means a bit longer term in terms of the economy, where interest rates settle, is a little bit more of a difficult question to answer. We've not seen interest rates this high since before the global financial crisis. So how business conditions, a lot of businesses that have done well with low interest rate environments over the last 15 years, how they conduct their business, how they do over the next couple of years with interest rates at the level that they are, is still a question that is a little bit unanswered as we go on into the next couple of years. But then you got also some employment figures out of sterling. I said you got GDP, some employment figures, probably not going to cause too much of an impact, these employment figures, but you do get some inflation out of the UK as well on Wednesday. What we're expecting is, what kind of market consensus, 10.9, so a decrease on last month's figure. Trading economics forecasts expect a higher than expected number. Well, if we look towards that, you know, in terms of the stagflation situation in the UK, it's a little bit more difficult to read into than the US state of affairs at the moment. I think a weaker inflation print means that the central bank, in terms of the UK, a weaker inflation print means that the central bank can slow down the pace of rate hikes, which with the recession that, you know, some people suggest we are currently in, not a technical recession just yet, but the Bank of England predict the recession last quarter of this year to last for the entire duration of next year. The lower interest rates can remain, the shallower that recession is likely to be. So, you know, maybe some weak inflation prints are actually seen as a positive for sterling going into next week. You know, they're higher, substantially higher than the rate of inflation in the US. So definitely one to keep an eye on. Maybe a weak figure in terms of the CPI next Wednesday for the UK may actually be positive for sterling. Apart from that, then I'm going to wrap it up there. Then I'll let you get on with your weekends. Best of luck trading PPI if you look to trade it in the next couple of hours. If not, there should be some opportunities with the CPI print next week, as well as the Fed, and we will cross that bridge when it comes to it. But that is it from me then, folks. Have a good weekend, and I will speak to you all again next week.